Okay, good afternoon, everyone. Thank you for joining today's webinar on bank taxes in Europe. It's great to see so many people here today. By way of introduction, my name is James Kemp, part of the senior management team here at AFME. Last week marked the publication of our inaugural report on European banking taxes. This was produced in collaboration with KPMG, who I'm delighted to have online with us today. And this report provides a comprehensive assessment of the current tax environment and puts forward some recommendations for the EU and their national governments. Of course, across Europe, governments are rightly prioritising growth and investment, but it's clear that the current tax framework for banks is a barrier to that same objective. So we here at AFME have consistently advocated for deep integrated capital markets that support economic growth. And today's focus will be on the role that tax policy can play in helping to achieve this, something that should be a priority for all of us. To be clear, European banks face some of the highest tax rates amongst global financial centres, both in terms of the general corporate and employer taxes paid by all companies, and also the sector-specific taxes introduced in the years after the global financial crisis. These high rates, combined with uncertainty and speculation around the future taxation of banks, send a negative signal to international investors in the world where capital and talent are increasingly mobile. Many of these taxes are not just a burden on banks, but have far-reaching consequences for the wider economy. There's a considerable body of research which indicates that these bank taxes are often passed on to the end consumers. One example of this transition mechanism, which we consider in the report, is the impact of financial transaction taxes across the EU and stamp taxes in the UK. We demonstrate that these taxes not only have an adverse impact on equities trading, but at the same time increase the cost of capital for companies. That reduces the value of pensions and investment for retail investors. And this is just but one of the many examples where tax policy directly impacts growth and investment. We do understand that tax reform is complex, but creating a tax environment that enables growth and investment is a key component of making the EU's Savings and Investment Union, the SIU, a reality and a success. By facilitating cross-border activity and supporting digitalisation and innovation, well-planned tax frameworks can contribute to addressing the EU's investment gap identified by both the Draghi and the Letta reports. We strongly believe that tax policy making should not be developed in silos, but should be fully integrated into the SIU and into the EU's wider competitiveness and simplification agenda. In the UK, the government set out an ambitious financial services growth and competitiveness strategy, which we strongly support. Yet it is essential that, again, tax policy complements this long-term vision for financial markets, rather than the continued tax takes from the industry. It will be a missed opportunity both in the UK and in the EU if the benefits of regulatory reform and momentum around competitiveness are undermined by a tax policy that is developed in isolation from these broader agendas. The recommendations that we've published alongside the report provide a blueprint to support tax and VAT reform in the way that is meaningful, proportionate, and competitive for both markets and consumers. So finally, I'd like to finish by taking the opportunity to thank Ian Sandals from AFME, who's run with this project, and to thank KPMG for their work in producing this report. There's lots of numbers in here, which I know the team are going to run through, and I'm delighted to therefore hand over to Mark Semple, who leads KPMG's financial services tax practices across Europe, the Middle East and Africa, and who is going to provide an overview of the report, along with his team, and the key findings. So many thanks, and I look forward to all of the discussion that we're going to have.
Thank you very much, James, for that introduction. My name is Mark Semple. I'm a partner based in KPMG in the UK, and I help out with our regional tax practice for financial services. So here's the background. Hopefully people have had a chance to read the report. I can strongly recommend the read. I think it's brilliant, as you can probably imagine, but it's really insightful in terms of the way we see it at KPMG, the current landscape. And it's not just the way we see it, but it's basically backed up by lots of other research with the IMF, EU Parliament, Central Bank, and many others quoted in the content. The report's in sort of two pieces. There's a sort of KPMG analysis of the current landscape, and then there's the AFME sort of policy recommendations as to what AFME think would be good for governments around the region to be thinking about when it comes to bank taxes. So my just 3 points before I hand over to David and Gert, who've been the people responsible for producing the report. Firstly, complexity. So, just looking at the current picture of taxes in Europe for banks, and I suspect I'm preaching to the converted here. But the complexity of the banking tax landscape is something to behold. Firstly, you have different sorts of taxes. So we have sort of bank levies, we have profit taxes, we have recently had introduced in many jurisdictions kind of windfall taxes on so-called excess profits due to interest rate rises in the recent history. All of these taxes, even within each class of tax, operate differently in different countries. And it's not like there's been one general framework of these taxes that countries implemented. I mean, you might look at something like Pillar Two, for example, and say at least there's a framework there which would help some level of complexity. These have all been domestically introduced, although some have been copied from other countries, they're still all quite distinct, which makes it a nightmare for advisors and a nightmare for banks to be able to comply with them. Um, and as an industry, that's not 100% unique, but it certainly is probably worse than most other sectors who have to comply with different sorts of taxes in different countries. So banks are sort of being penalised, not just in terms of the amount of tax, but in terms of the complexity of those different taxes in different jurisdictions. Second point on the cost, and David and Gert will talk about this, and James already alluded to it. But there is a significant cost in being a bank and doing business in the financial services sector in the region compared to other regions. And that cost is sometimes borne by the bank, but sometimes is is ultimately a cost to the customer or the counterparty. So this isn't something that is a small amount. It does potentially contribute to a bank's regulatory capital, its competitiveness, and also distorts potentially economic decisions that would otherwise be made. I'm not saying that's a good or bad thing from a KPMG perspective, but I think the research does show this is the case. So the second point is around cost. The last point is around competitiveness. And when reading this report, I'm always mindful that I'm a tax geek reading a report about bank taxes. And I've mostly advised banks in my career, so it really is in the sweet spot of stuff that I'm interested in. But I read it in the context of, what does this mean in the rest of the commercial world around banking and where people locate their businesses. So I think it's also important to realise that tax is not the only factor in terms of where businesses locate. There's obviously the regulatory regime. There's where people want to live, where the markets are, where the market infrastructure is. But what I do think this report does show is how important tax probably is in the decision-making process. And I suppose importantly, how it can be different in different countries. So I think that's the way in which I read this report, as a tax uh, someone who loves tax geek, I want to say. This needs to be taken in the round of other taxes, but this really does go to the heart of why tax is such a fundamental factor when businesses are looking at countries to locate or to invest in. So I think with those initial remarks, I will now hand the baton to David Wren, who has co-authored this report and done a lot of hard work in putting it together. Thank you, David. Over to you.
Excellent. Mark, thank you very much. And yeah, as a fellow tax geek, I will kind of talk through some of the most interesting, I think, findings of the report and what we found. As background, the report really focuses on four main sections alongside AFME's policy recommendations. So we look at what we're calling bank-specific taxes, so bank levies, corporate tax surcharges, and many other approaches to raising taxes targeted at banks, and we'll certainly come back to the idea of it being targeted. Financial transaction taxes, and we've tried to cast the net quite widely here, and we talk about both the sort of old and new financial transaction taxes, UK and Irish stamp versus what we see in France, Italy, and Spain, but also those newer measures that we're seeing a bit more kind of ad hoc in places like Hungary and Slovakia. VAT on financial services, and particularly the status of the exemption, and Gert will talk to that in a bit of detail. And then finally, and particularly for those of you who've I've had the chance to work with before, you'll know that a lot of my work is around operational taxes, a little bit just on the changing role of banks in tax administration, and actually the reliance of governments of the EU, and indeed of the real economy on banks to deliver that reform. There were a few kind of interesting facts I thought I'd pull out just up front, and then we'll look a little bit more into the findings themselves. And Renato, actually, who's going to join the panel later, was saying shortly ago, which is, when you look at the sort of windfall taxes, when you look at the measures, you're kind of aware of them happening. Clearly, there's a lot of response, a lot of challenge for people. But it's actually not until you sort of gather them all into one place that I was struck by just how many member states have introduced or increased bank taxes since 2022, which is when we saw interest rates starting to return to their sort of long-term norm. And we'll touch on that a little bit as well in terms of the perception of that versus how that really sits. Probably unsurprisingly, but again, I think a useful reiteration. Bank taxes in Europe are significantly higher than the US, Canada, Singapore, Hong Kong. And that's actually very connected to the fact that the return on equity is actually lower in Europe than we see in North America, for example. Really important. We found in one report and a good deal of consistency elsewhere. 76% of the cost of bank taxes is passed on to the real economy. And so that's things like financial transaction taxes, clearly the VAT exemption. Those have a very sort of direct impact on individuals, investors, institutions, etc. But actually, changing the bank's tax ultimately changes the cost of capital, and therefore you see those costs being passed on in a very real way. As I say, one report found 76% of the incidence falls on the real economy. And then finally, and again on this point of tax administration, the EU Parliament really helpfully published a report just as we were finalising this, looking at the DAC ahead of the rewrite later in the year. Really interesting, I think, that in the EU, the Common Reporting Standard, DAC2, raises about 1.2 billion euros of additional tax a year. That's not loads, and certainly compared to some of the statistics that the OECD puts out for the rest of the world, the EU's probably seen less benefit. But it only costs tax authorities 30 million to administer. So, brilliant return, 30 million in exchange for 1.2 billion of additional revenues. What that glosses over, and fair play to the EU for publishing it, is it costs the industry 550 million a year to administer that. And clearly, the vast majority of that is going to be on banks and asset managers. And that clearly would not meet most people's kind of expectations of return on investment for such measures. So really, there's a sort of almost a hidden tax as well that we need to consider when we look at the obligations that are placed onto banks. The good news is we are not alone in worrying about these things and spotting them. And so, throughout this project and throughout discussions with Ian and with AFME members, we have found a large number of research reports, studies, etc., globally, including by the IMF, the EU Parliament, the European Central Bank, all of which echo these sentiments. And these four really are the kind of key messages that I found during the kind of writing the report, and I really sort of take away from the report. Interestingly, I think they all reflect almost myths about the banking sector. And I briefly considered rewriting this to be a sort of LinkedIn clickbait, 4 myths about your banking sector that are destroying your competitiveness. I decided that AFME's risk appetite probably wouldn't allow me to publish such a thing. But there's a couple of really important points here. So, firstly, the return on equity for European banks has not reached the levels to justify the windfall taxes that we have seen. And that's not KPMG saying that or AFME saying that. That's from the IMF themselves. And so just to look at that a little bit. So what we have here, and we've got a KPMG report called the State of the Banks that we publish annually, and some statistics, and also some IMF statistics as well. So we can see that EU banks and indeed UK banks had lagged significantly behind the US banks on return on equity, but also behind both the manufacturing and service sectors. And again, I think that will come as a surprise to a lot of people who perhaps have not been as close to all of this. And then even with interest rates returning to their long-term kind of trend, well, hopefully, we still find that all of the banking sector, including the US banking sector, still sits well below the service sector in terms of return on equity and broadly on par with the manufacturing sector. And however you might kind of look at the politics and the media around this, and I certainly won't get too much into that today, you don't hear many people talking about windfall taxes on the manufacturing sector. Indeed, most of the discussions tend to be about how we can support it, subsidize it, build it out further. The other key point, I think, is that bank taxes are much higher in Europe than they are in North America, whilst the return on equity is lower. And so, again, coming from the IMF and elsewhere, we see here, for example, the return on equity for European banks has lagged well behind that of both Canadian and US banks. And apart from a brief point during the financial crisis, that has been consistently true for quite a long time, and certainly post-financial crisis. And from the IMF, they said there is limited evidence to suggest that banks are making excess or extraordinary profits by reference to return on equity in other sectors. That also then applies to what we are seeing globally as well. And just to sort of build out on that, the research that's out there, including from other industry bodies, shows that a bank in the Netherlands might be paying tax a total tax rate as high as kind of 42%. A German bank, in the region of 38, 39%, whilst a US bank is probably somewhere below 28%. Financial centers in Asia, including increasingly in the Middle East, have no bank-specific taxes at all, and therefore the tax rate is the same as the rest of the industry. And of course, London has the highest bank tax rate of any major financial services hub, with the combination of things like bank levy, the surcharge, and many other measures that apply. So actually, even if we are, before we get into the sort of fragmentation and the agenda of the Draghi report, we can already see that the headline tax costs are making the EU uncompetitive against the rest of the world. At the moment, there is clearly a huge kind of focus on the competitiveness agenda, both for the EU and the Draghi report, which has already been mentioned, but also for the UK and I guess our continued search for a place in a post-Brexit world. So there is a recognition almost universally that the lack of harmonisation in the EU is causing a drag on the economy and a harm to the union's competitiveness. The Draghi report actually kind of specifically highlights fragmentation in the banking sector. It briefly mentions taxes, although that's not its primary focus. But the European Parliament themselves concluded last year that the range of banking taxes using different tax bases, different calculations, different measures are blocking economic activity within the EU and potentially creating a non-level playing field for competitiveness. And then finally, actually, and for me, I think one of the most interesting areas to read all of the research, but most bank-specific taxes are not limited in their effect to banks. Taxes on banks affect the cost of capital, and that cost is passed on to users of financial services. There's a wide body of research that broadly supports that. To say one finding, particularly robust, suggests about 76% of the cost of taxes is passed on to end users. Other reports found slightly different measures, slightly different ranges, but all of them indicate that some of that cost is being passed on to the investors, to everyone from individuals right up to institutional clients. In fact, you can actually go a stage further, and one of the reports indicated that the cost is most commonly passed on in places where people are less likely to move banking relationships, change services, or go elsewhere. And of course, as we all know, that is predominantly the consumer market. And so what we're actually seeing is consumers are most likely to be affected by those because they are the least likely to move, and therefore the incidence of tax tends to be passed through, due to the elasticities of pricing. All of that's even more true for financial transaction taxes, and one report in particular from the EU Central Bank concluded that the biggest result of the French financial transactions tax was a disguised tax on savers. And I think that's a fairly kind of startling and clear message from them in terms of what's happening. A study by the University of Valencia kind of particularly focused on the fiscal cost to households that comes with higher interest rates and higher fees as well. And of course, any move to curtail or change the FS exemption for financial services, which Gert will talk to, will have a huge impact on that as well. So really important, and I think one of the key messages is that taxes on banks aren't just taxes on banks. And I think actually that's a really important message to kind of come away with. And then finally, and not on my list of 4 points, but something that we have kind of highlighted in the report, and I know has been highlighted in AFME's kind of policy recommendations as well. Ever since the Americans came up with the idea of FATCA in particular, the idea of deputizing the banks as information gatherers, information providers on behalf of tax authorities has extended and extended. We see now CRS, FATCA, DAC6, CSOP, which is payments reporting. We've got DAC8, which is crypto assets. We'll soon have MiCA Div and FASTER on withholding taxes, plus, of course, the burden of e-invoicing in the indirect space. So that idea of deputizing the banks has become really, really standard. But not just that. The involvement of banks is critical to things like the success of FASTER. FASTER, kind of the withholding tax changes coming in Europe, which I'm sure many people on the call will be aware of. FASTER is consistently kind of referenced as a move towards EU competitiveness, bringing down internal barriers towards the free movement of capital. And yet, it is predominantly focused on compliance, on additional burdens for banks, and much of the policy is evolving in that direction. And so it's really important to remember that banks aren't just taxpayers, they're also a vital part of the infrastructure for compliance, for supporting governments, and indeed, of course, supporting the real economy. With that, I will finish up on the report itself, and we'll probably talk, I'm sure, more about it in the panel. But at that point, let me hand over to Gert-Jan van Noorden in our KPMG Netherlands practice, who's going to talk us through VAT.
Yeah, thank you very much, David, and greetings from lovely Amsterdam. An honor to be part of this webinar and to have contributed together with AFME to this great report. Clearly, when discussing competitiveness of the banking sector in Europe compared to other sectors of banking across the globe, the VAT context is vital. In many occasions, one would think that is absolutely great. If you have an exemption for something, right, it means you don't have to do anything. Sounds good. But in this context, as well, you will probably all know, the difficulty lies in the fact that you do not charge VAT to your clients as a bank, but the back end of that is that you cannot recover VAT on your cost. And that model definitely puts banks in Europe in a different position compared to other banks across the globe, specifically if you compare those with US banks. So the cost and the irrecoverable cost for banks is a vital competition element, and what we've tried to do also when drafting the report is to put some numbers to the issue. And if you look at it, for example, from an EU angle, the estimation is that almost 46 billion a year is borne by European banks as a cost, and simply a cost of doing business as they do, which puts them in a different position compared to banks elsewhere. From a UK perspective, and clearly also an angle that we've looked at. Well, we used to look at us together, but you decided for Brexit. Oh, I'm not going to say that. But in any case, it's 4.3 billion irrecoverable VAT annually for the UK banks only. And if you compare it also with the total cost of UK banks, that's almost 25% of total taxes paid by UK banks. So this is actually a clear issue, and an issue that perhaps from a policy perspective, well, could be solved by means of simply charging VAT or allowing banks or perhaps obliging banks to charge VAT. So that brings us, well, to a certain extent to the question, also in considering potential solutions, why do actually these exemptions exist in the European VAT systems, both on the Amsterdam side of the channel as well as on the London side of the channel? And clearly, the policy objective is to ensure that finance and financial products are not burdened by tax, and at least to have consumers enabled to well, take part of financial products in their daily lives. So there is a clear policy driver for that. Next to that, in terms of rationale for exemptions, typically it is pointed out that in financial products, for example, in derivatives, but also in the deposit space, it is not easy to determine the actual value add and actually to determine the tax base of those type of transactions. And some of these, let's say, technical issues and technical difficulties are solved by the introduction of the exemptions. So on the one hand, the consumer that is relevant, and the other hand, let's say the technical difficulties. But, and I think that's super important to keep, let's say, mentioning, is that this exemption is not a tax advantage to banks. And that may sound quite understandable and logical for everybody, perhaps on this call, but for those who remember the discussions that we had when in 2011-ish, we had the initial discussions on the EU-wide financial transaction tax. Clearly, from a European Commission perspective, it was pushed as a tax that more or less was there because those banks, those nasty banks, were benefiting from these great exemptions in the VAT space. So that is something that's definitely not true. So when considering, and that's also what we did as part of the report, when considering potential policy options and improvements, perhaps the most bold way to go would be to simply get rid of all exemptions, to abolish them. But, and I think there well, is common understanding that option is not a valid policy option because it would increase the price of financial products for consumers, so mortgages, well, what have you. So actually moving in an all taxation model is definitely not something I think that we would recommend for Europe. On the other hand, the question is, why would you not, for example, try to move into a, let's say, partial taxation space for example, by taxing B2B transactions, because typically businesses would then be able to deduct the VAT on financial product offered by banks. Well, I think there are many difficulties and questions to pose in that respect. One of the key items is also there that, for example, the liquidity cost for businesses would increase significantly in terms of financing, but also it would give rise to potential disruptions in a otherwise stable way of operation. And I think one of the key items that we have and should have in our banking industry and in the European society as such is stability from a financial end. Next to that, and I think that is flagged quite often, also taxing B2B banking services obviously would give rise to additional cost for vulnerable sectors such as health, education, and government itself. And next to that, as the example, I think, of the carbon emission trade in the past has showed, whereby that was transitions into a VAT taxable space, that it opens the door to all kinds of potential frauds, which we would not like to have, obviously, in our space. So when considering, let's say, potential future options, I think we would, and I think that's also the conclusions we've drawn in the report, we would feel that the rationale for exemption is still there, and we would advocate for keeping the exemptions in place, albeit, and I think that is a wish for quite some time already in the markets, both on the continent as well as in the UK, to modernize the VAT system, modernize the VAT exemptions, also to reflect changes in the landscape. Fintech clearly is something that has entered our daily lives, I would say, and we do need solutions and policy changes for that. All in all, what are then perhaps the things to consider and at least to keep in mind is that modernization at least should be done in a way that is predictive, and that allows for greater certainty, because also, as many of you would know, across Europe, there's quite some DTA discussions, tax authority type of discussions, litigation in this space. And obviously greater certainty definitely adds to a better competitiveness for the banking sector in Europe compared to what we see elsewhere on the globe. And with that, I can kindly hand over to Ian to take you through.
Great, thank you, Gert-Jan. For those of you who don't know me, my name is Ian Sandals and I lead AFME's tax work. I'd like to thank KPMG for their excellent presentation today and for all of their work on the report. Now, the report has two components, the detailed analysis from KPMG and the AFME recommendations. Let me briefly summarize the recommendations and then we'll go to Q&A with our panel. Please submit any questions you would like to ask in the Q&A box at the bottom of your screen, and we'll try and get through as many of those as possible. Now, our policy recommendations are shown on this slide, but I think our main recommendation is very simple, and James has already covered it. Tax policy is not just for tax geeks. Tax policy needs to be part of the bigger picture around growth and competitiveness. So that means that policymakers need to look at both the overall tax environment for banks and the impact of specific taxes. Now, to discuss these, I'm joined by Renata Choquer from UBS, who chairs AFME's tax committee, and by Mark Huyen from State Street, as well as our speakers from KPMG. I'm going to start with a couple of questions that have already been submitted, then we'll take questions from the audience. So please do put these into the box under Q&A at the bottom of the screen. And I think the first question I'd like to ask is, our report is very focused on the high tax rates in Europe, but most banks are global institutions. So I think this is perhaps one for Mark Semple. How are banks responding to the taxes highlighted in the report, and to what extent is tax a factor in banks' decision making?
Yeah, thank you, Ian. I think on the first part of that question, I would say banks are responding by having to deal with it, firstly, and there's the extra cost of it, and as I alluded to, the complexity. And I think that's in itself quite difficult to deal with. That these aren't just corporate taxes with an increased rate or an increased item in a corporate tax. They're a whole new framework of taxes, and they're all quite different, as I alluded to. But also the manner in which they're introduced. So I think quite often these are just introduced. There isn't a lot of consultation around it, and not consideration of some of the things you were talking about there, outside just the need for countries to raise revenue quickly. So I think banks have been coping with them, but it's been, I think, quite challenging in sometimes in some countries. I think on the second question, the jury's out, I think, as to certainly the more recent changes and how determinative they might be around where people invest and where banks locate. I think I always like to look at the Brexit history that happened and tells us that tax is an important consideration around where to locate. Ireland was always very attractive because of its low, stable tax rate, but also other factors such as the banking regulator was also important, and so many banks chose not to set up in Dublin as part of their Brexit strategy, but in places like Frankfurt. And then there's always the fact that bankers like to live in cities generally, and want to live somewhere that's that's good to live as well for themselves and their families and friends. So, we've seen recently lots of banks finding themselves in places like Paris, despite the maybe the higher tax burden as far as the bank itself is concerned. Just as a quick aside, I remember back in the UK in sort of 2010 when the marginal income tax rate for high earners went up to 50%, or above 50% for many high earners, and lots of hedge fund managers were advised to leave London and move to places in Switzerland. And they didn't decide to move in the end because their partners and children went to visit the place in Switzerland and didn't want to live there. So there's a human factor as well as just the headline tax rate. I would say, to answer your question on that one, Ian, I think generally the regulatory regime is the most important thing for banks, and tax rate, the amount of tax that's paid comes certainly up there in the next level of decisions, second or third factor, I would say. And on tax, the other thing to think about isn't just the headline tax or even the amount of tax that's paid, but also, more and more heads of taxes are concerned about, the approach of the tax authority, the ability to get, some certainty, get clearances, penalties when it goes wrong. Some countries have pretty quickly gone into criminal sanctions for tax, arguably when it's really a civil thing in some countries, but criminal penalties do exist. And the court system and the ability to litigate and get to a sensible answer is also important. So I think those are all very important factors as well that people need to take into account when it comes to tax, not just the pure quantum of the tax or the complexity of it. Hopefully that answers your question broadly.
Thank you, Mark. That's very helpful. Now, the report describes the introduction of a large number of new taxes in recent years. So I think my next question is around implementation. And perhaps Renata, this is a good one for you because you've been heavily involved, particularly in the introduction of FTTs and similar taxes. What has been your experience in terms of implementation, and what are the key takeaways?
Thank you, Ian. Thank you. Well, firstly, I'd also like to thank AFME and KPMG for the work that's been done in producing the report. It's very comprehensive and very interesting read. So yes, as Ian says, I'm in-house. I'm one of the people who quotes deal with it. And over the last 15 years, I've spent a lot of time on the implementation side of FTTs, dealing with questions from the business, clients, etc. I think my experience really started on France and the French FTT. And when that was first introduced, the backdrop is, of course, that the responsibility for paying and accounting for the tax lies with the brokers. That's generally quite a lower margin business, but with very significant transaction flows on a daily basis. And as the tax base is the market value of the securities, the risk of getting things wrong is quite significant. And in addition, what else did we think when this was introduced? Well, we wanted to make sure that there was a common understanding across the market of how the tax was meant to operate, because it was important that transactions settled without breaks. And by that, I mean that, each of the parties to the transaction had to have a common agreement on whether the transaction was taxable or exempt. And so to reiterate what a couple of the earlier speakers have mentioned, our key requirement was certainty, certainty in how the rules apply. Is there a common understanding across the market of how the rules are meant to apply? And also, do we share that understanding with the tax authorities? Because that minimizes risk. Two other factors that are important to us is, do we have sufficient lead times to build all the systems and processes? And is the tax simple? Or can we get the tax to be as simple as possible? Because that also reduces, the cost of implementation and the minimization of risk, which speakers have referred to earlier. The costs of implementation are important. So I was kind of thinking back over the last 15 years and what worked well. And when French FTT was first introduced in 2011 or 12, we really welcomed being invited to the table as an industry with AFME. Bunches of representatives went over to meet directly with the French tax authorities, and it meant that we could explain concepts which are very understandable to us in the brokerage business, but maybe not to people outside the banking world, such as chains of brokers, dynamic hedging, netting, and give diagrams and give examples. And because of that continuous dialogue, both with the French tax authorities and with AMAFI, it led to the development of guidelines that could be used in-house, and Q&As and things. And so we were able to kind of develop and get that common understanding across a broad range of transactions, and that was very important to us. We were also able, or AFME was able, to develop the FTT protocol, and I'll come on to that in a minute. That experience was replicated in Italy and Spain. And, we do welcome the ongoing assistance we get on an annual basis from the tax authorities, because they do publish the lists of companies that are in scope, which is very useful for us and, again, helps us achieve that certainty. Another thing we like is golden sources. So, for instance, and well-designed taxes. So, when the Irish have introduced their recent low cap exemption, they approve the applications for exempt securities, and we get a golden source because they publish the name of the exempt securities on their website. So, we would, from where I'm standing, yes, there's a policy aspect, but the implementation is more important to us, and it's the certainty that's key, and that dialogue with the tax authorities. For lead times, I would say my experience has been, for a new tax, we typically need 6 to 12 months for a lead time in order to kind of develop the internal processes, the internal systems, to talk to clients. But even with small changes, like rate changes, ideally we like 1 to 3 month lead times. And, there have been instances where we've had very, very short lead times, sometimes only a couple of days, and that's proved quite tricky, particularly at year end. To the final point, simplicity and minimizing costs. On the FTT protocols, that I think was one example which was really welcome, because it's a very simple way for market participants to document the responsibilities of each of the parties to a transaction flow. We had the luxury of external counsel helping us draft that AFME protocol. And we were also able to share it with the French, Italian, and Spanish tax authorities. And what that has done is remove the need to negotiate multiple bilaterals, reduce costs of doing so, and again, have this common understanding across the market. So yeah, I mean, I'm just reiterating really some of the messages that have come through in the KPMG report, which is, we like certainty, we prefer, we like non-fragmentation, and we like longer lead times.
Thank you, Renata.
So I think, yeah.
That is very helpful. The next question that's been submitted is around progress on the Savings and Investment Union. And with all the challenges that pertain to tax policy making in the EU, how can tax play a role in that? Mark Huyen, what's your view on that?
Thanks, Ian. So maybe I'll start at the final end goal rather than talking about the Savings and Investment Union first. Hopefully, we all agree that having easy access to finance and having a low cost of finance is what is required for growth. Unfortunately, I think in this day and age, even whether or not growth is a good idea or a justified end goal is sometimes open for political debate. But let's leave that aside for a second. Just assume we want growth. So you need cheap finance, you need access to finance. And I think as our friends at KPMG have made very clear during their presentation, when you pivot to the SIU, there are a couple of things that they're trying to do. Number one, they're trying to grow equity markets within Europe. And number two, they're trying to remove administrative burdens or barriers, right? Some sort of harmonization approach. Well, number one, I think the proliferation of FTTs and other transactions taxes clearly is going to form some level of impediment to capital market growth. Secondly, whilst there is an initiative to export the idea of a savings and investments account, so similar to what you have in France under the PEA regime, or of course ISAs in the UK, if you model European capital markets or equity markets against others, particularly the US, you get to some pretty interesting stats, right? And this is what actually the Commission has done themselves in publishing the SIA, the Savings and Investment Account Initiative. So they said net of inflation, you would have gotten about a 50% increase in value of your money since 2009 to 2024. And actually, if you look at the Euro Stocks Index all the way back to 98 to 26, you've got about 80% growth, right? Which is great. It's clearly better than putting money in the bank in a deposit account. The S&P 500 has grown 800%. So unfortunately, regardless of how much tax you charge or how little tax you charge, or whether you completely exempt all the gains in income, you're not going to make up the difference. So it seems like there are more fundamental things afoot. And I'm not going to go into all of the bank sector-specific taxation. KPMG have already done that and talked about how that may be passed on to consumers. I will talk a little bit about some of the administrative burdens, because that is meant to be one of the things that the Commission is looking into, right, into reducing. And as David said, just in the past 10 years, we've had FACA, we've had CRS, we've had CARF, we've had DAC 6, we've had the Spanish FTT, we've got MiCADIV coming next year, we've got FASTA coming after that. And I'll be honest with you, I'm pretty skeptical about that 100 million number. I think that's just an estimate, right? I mean, I think the easiest way to sort of think about the cost to banks is David and myself over the past decade have become somewhat subject matter experts in FATCA and CRS and all things AOI. There is an alternative universe, David, where neither of us would have gotten involved in this, and maybe we would have become experts in something else, right? But no, here we are. A part of my brain is locked away with knowledge of PNFFEs and whatnot, and I'll never get that back, which is fine. It pays the bills. But I guess there's an ultimate point there as to, is it delivering value for money, and what kind of burden does it introduce society-wide?
And I was sorry, and I might just say quickly on savings and investment accounts. And I think the EU recommendations on that are really interesting, because they clearly combine tax benefits and compliance benefits, but also kind of recognize this need for people to understand investment, but also tax. Mark and I outed ourselves as tax geeks. I'm sure others on the call would probably say the same. But actually, one of the things that the sort of patchwork quilt of taxes across Europe stops is ordinary people looking to invest, understanding why they're going to get a different tax on a dividend from Chevron versus one from Siemens, or whichever other equities you look at. So there is also a really important piece, I think, about public understanding of tax, which hopefully things like this report help. But actually, when people are making investment decisions, do they really understand what the differences are, or indeed why there are differences?
Great, thank you, David. And one final question, I'm not sure who's best placed to answer this. Are there any tax changes coming down the track that particularly concern us? Who wants to take that one?
Mark, do you want to say faster, or shall I? Faster, as Mark says, 10 years of our life on FATCA CRS, the next 10 years of our life, I suspect, on faster. It's a big feature of the Savings and Investment Union, and its very intense compliance requirements are all borne by the banks. So again, you've got this idea that you need the banks to successfully navigate tax policy in the way that Renata talked about, in order for this huge kind of tranche of the EU's overall policy to execute. You might equally look at something like transaction taxes and the UK consideration of stamp duty. Really, those tax issues are incredibly, I think, important to the success of kind of wider government plans to increase investment. But also, I should pause there and throw it open to others in case there's other things that are concerning.
I think it's an opportunity just to get involved in what the EU Commission is trying to do around simplifying tax. So they've released this so-called tax omnibus initiative, which was announced last week, and it's not driven towards banks, but it's about trying to simplify red tape and unnecessary reporting and regulation in regards to tax. Direct tax. This is not indirect tax, just direct tax. So I think AFME and sure will be getting involved in responding to that and making sure that we don't just have non-banking tax that's simplified, but also banks get their fair share of that as well. So try and end on a positive note, Ian.
Great, thank you. I'm conscious that we've gone over time, which I think is a reflection of the quality of the discussion and the complexity of the issues that we've been talking about. So I'd like to thank all the speakers for taking part and thank all the participants for joining. I think we've covered a huge number of issues, and no doubt we'll continue to be focusing on these issues going forward. So thank you all very much for your time this afternoon.
Thank you, Ian.